Hello, my fellow investors, and welcome back to another earnings report video. Guys, Chevron had earnings on Friday, as well as ExxonMobil and Procter & Gamble, as you guys can see right here. Now, I today want to cover Chevron as well as ExxonMobil. So let's take a look at these companies, guys, because, well, Chevron it's definitely a highlight in my portfolio. Biggest gainer for me when it comes to dividends as well as just overall capital gains. And, well, you know, I actually bought this company when it was at around like $100. In fact, I will show everybody this in just a little bit. Just understand that right now, because of oil going up so high, yeah, most oil companies may be out of the scale to buy. However, we're going to do a full discounted free cash flow approach to see what kind of price we should pay for this company, as well as take a look at the 5-year average when it comes to all their numbers, as well as, of course, the current earnings. So with that said, let's get started with this analysis. So here we have the earnings report. And I'm actually going to start with this because if we actually come over here to Seeking Alpha, I don't know if this is correct or not, but this is showing 723, but again, this is Chevron, but their earnings were clearly, on Friday, not the 23rd. So I'm looking at this, I'm like, okay, I don't know what you guys are doing here. So let's just go directly into their earnings report, which, like always, this will be linked in the description below. So we got Chevron report second quarter 2023 results. Reported earnings of $6 billion, adjusted earnings of $5.8 billion, reported record Permian Basin production 11% higher than a year ago, record shareholder distribution of $7.2 billion, PDC Energy Inc. acquisition expected to close in August 2023, so next month. So right there, this is looking all right, I guess you could say, but we do have to make some comparisons to that of last year, and also understand that because this acquisition is closing in August, yeah, next time we see their earnings, we might get, actually we might not think, we will see a drop in their cash flow. Obviously, cash from operations less your capital expenditures. Capital expenditures does involve acquisitions. So now what we got over here, it is pretty much what we just saw over there. We got Chevron reported earnings of $6 billion, which ends up being $3.20 per diluted share. Second quarter 2023 compared to $11.6 billion, $5.95 per share diluted in the second quarter of 2022. So that is a pretty big drop, guys, right? Going from 11.6 billion down to 6 billion, 595 down to 3.2. So yeah, what is the cause of this? Well, it's actually not as bad as y'all think, and I will cover this in just one second, but let's actually come down here because, well, we can actually see the effects of as to why we can actually see the effects of the oil demand come down. And, well, that has a strict correlation as to what these numbers up here, going from 11.6 billion down to 6 will do. So we got upstream. Now this is the earnings and cash flow. Now this is the earnings and cash flow summaries. We got the upstream when it comes to total earnings. Now look at what this one was, guys. Q2 of 2022, $8.55 billion. And look at what it was Q2 of 2023. Almost $5 billion. That is a drop of $3 billion. That's just on the upstream alone. Again, upstream, it is when they take it up from the ground, right? When you see those giant oil hammers kind of stuff, that's upstream. When it comes to downstream, take a look at this. Cut in half. We got 3.5 billion down to 1.5 billion. That is a pretty big drop, right? That's a pretty big drop. And all others, you can see that they went from negative 459 to negative 443. So it's a little bit better there, but still, these two, the upstream and downstream, are definitely swinging everything to the downside, right? Now, earnings per diluted share, we pretty much just saw this, right? We got, $5.82 down to $3.08. We already saw that, right? Cash flow from operations, CFFO, we got $13.8 billion down to $6 billion, $6.3 billion to be exact. That is a lot, guys. That is a lot. Now, on a year-to-date perspective, when it comes to the upstream, this is a drop of $5 billion, going from 5.5 billion, going from 15.5 down to 10.1. On the downstream is 3.85 down to 3.31. And when it comes to the cash flow from operations, we got 21.8 billion down to 13.5. Wow, that is an insane drop. So what caused this, right? What caused this? So with all of that said, let's see what the CEO has to say. Now, the explanation for why these things are going down it's actually mentioned here, not the CEO, but it actually is mentioned in the earnings report, and it's not that bad as you guys would think. We got, quote, our quarterly financial results remain strong and return record cash to shareholders, said Mike Wirth, Chevron chairman and CEO. The company has delivered more than 12% ROCE, which is return on capital investments? No, employed, sorry, return on capital employed, which is right over here, which is really, really good, guys. You really want that ROCE to go up, right? For 8 straight quarters and returned $7.2 billion to shareholders in the quarter, an increase of 37% from the year ago. Strong execution resulted in record Permian Basin production this quarter. With continued, Chevron plans to further increase its investments in the United States with the announced agreement to acquire PDC Energy. With the agreement to acquire PDC Energy, our consistent performance and disciplined use of capital are driving superior value for our shareholders, he concluded. Now here we have a bunch of other metrics. In fact, we just saw this one, ROCE. We got in Q2 of 2022, look at that, 26.5 down to 13.4. Wow, that's a massive drop. Now, what did he just say though? What did he just say? The company has delivered more than 12%. Okay, I see. The company has delivered more than 12% for 8 straight quarters. Interesting, because I'm looking at this, I'm like, wait a minute, this just went down, but why did he mention as if it was positive? Oh, because he just said we're still returning more than 12%. Even though when you take a look at this, it shows that it has decreased by a pretty big margin, right? Pretty big margin. Now, when it comes to the capital expenditures, we got 3.2 up to 3.8. We're probably going to see a lot more of this because of the whole acquisition with PDC as we just saw. Now, we actually have over here the free cash flow. Take a look at this. 10.6 down 2.5. That's not surprising for a multitude of reasons. And obviously the acquisition is one of them. But also, guys, the big one, and we're actually going to see it right here, is the fact that, well, oil prices have come down, right? Now, as of recently, they've gone up. But for the past several months, we have seen CPI. When it comes to the itemized version of the CPI, we have seen energy, specifically energy, deflate, right? Deflate. So, you know, when in the past year, when you had oil, gasoline of all types being up positive 40%, and then automatically going down negative 20%. Yeah, that's going to cause issues, right? That's going to cause issues, especially when it comes to their bottom line. So that's not really surprising. Now, financial highlights. I really do want to cover this. We got second quarter 2023 earnings decrease compared to the second quarter of 2022, primarily due to the lower upstream realizations and lower margins on refined products, which we just saw right there. So upstream, right? They're having, I don't necessarily know if they're having issues bringing stuff up, or is it just mainly geopolitical stuff, right? Because we do know that right now there's a big war. There's a pretty big war when it comes to the whole entire energy sector, right? Sales and other operating revenues in the second quarter of 2023 was $47.2 billion, down from $65 billion in the year ago period, primarily due to lower commodity prices. And there it is, right there. That by far is the biggest outlier and the biggest mention as to why everything, like all of their stuff is going down, right? That right there, guys, is huge, because commodity-based companies always tend to follow their respective commodity. Oil, very, very volatile. Of course, as of recently, it has gone up, but man, I'm going to show you guys the graph in just a few seconds as to like how much things have actually fallen, and as of right now, how much things have actually gone up. We got worldwide net oil equivalent production was up 2% from the year ago quarter, primarily due to Permian Basin production. Okay, so they're not having, okay, so I'm taking that back a little bit. They're not having issues when it comes to the getting the barrels. Man, it's just lower upstream realizations. All right. It is what it is, man. CapEx in the second quarter of 2023 was up 18% from the year ago, primarily due to higher investments in the United States. So there you go. Another example as to why it's just like, all right, you know, cash flow's going down, but cash from operations less your capital expenditures. Where is this CapEx going? Well, you know, if it's going into higher investments in the United States, if it's going into the acquisition of, if I can find it over here, the acquisition of PDC Energy Inc., all of this stuff is great, man. All of this stuff is great. So I'm going to expect cash flow to come down now. Quarterly shareholder distributions were a record of $7.2 billion during the quarter, including dividends of $2.8 billion and share repurchase of $4.4 billion, over 27 million share repurchase during the quarter, and nearly 50 million shares year to date. That is insane, guys. Absolutely crazy. The company's board of directors declared a quarterly dividend by $1.50 wow per share, payable September 11th to all shareholders of common stock as shown in the whoa, I really do hope that Seeking Alpha has actually reflected this. So that's insane though. That's so crazy. So here in the business highlights, I'm actually curious because I just saw this first point and I'm like, they mentioned PDC, so let's see. Announced an agreement to acquire PDC Energy Inc. in an all-stock transaction with closing anticipated August 2023. This acquisition is expected to add $1 billion to annual free cash flow. All right, cool. So I wonder how much is costing them. Oh, actually, no, a full. Oh, I'm gonna have to do a little bit more research on this. 1 second. And I was just curious because I'm like, okay, if they are planning to buy in all stock, like all shares outstanding for this company PDC, well, how much are they actually paying for this? And here we have it right here. So actually, I just did a very quick Google search, guys. I literally just did Chevron to acquire PDC Energy, and then I just clicked on the first article. And if we come down here, we can see this was as of May 22nd. Chevron announced today that it has entered into a definitive agreement with PDC Energy Inc. to acquire all of the outstanding shares of PDC in an all-stock transaction valued at $6.3 billion. So they are paying 72 cents per share. Wait a minute. Now I'm curious. Hang on just a second. Now I'm very curious. What in the world, PDCE, what in the world is their share price right now? Hang on a second. Wait, 72, wait, what? Hang on a second. $72 per share. I read that 72 cents per share. I'm like, what? How does it make any sense? So yeah, they are buying this at 72, and the price right now is a lot higher. So if you guys are buying into this, you guys are probably going to lose if you do not know that this is happening. So yeah, if you're buying right now at 73, I would refrain because Chevron's buying this out at 72. So it is what it is. Now, if we take a look at this further, we can see that, of course, $6.3 billion. And if we come back into their earnings report, this acquisition is expected to add $1 billion to annual free cash flow. So it'll take about 6 years for them to essentially break even. Now, that is give and take, right? Because of the fact is that, well, they're expecting $1 billion. Doesn't mean that they're going to get $1 billion. But let's say in the next 6 years they average at $1 billion. I don't really see that as too much of a big deal, right? So with that said, I guess that's really all that I wanted to take a look at, unless we have anything regarding. Well, here we have. Let's actually see over here. Do they have this by segment? I did see something relating to the Permian Basin. U.S. net oil equivalent production was up for the second quarter and set a new quarterly record primarily due to growth in the Permian. Okay, all right. So, man, their upstream is just really bad right now. They're really struggling when it comes to their upstream. So, interesting. U.S. net oil equivalent production was up. Notice this, guys. Upstream is actually. Oh, okay. I see. When it comes to the earnings. Okay. So when it comes to the earnings in this upstream, it's not necessarily the fact that their oil is actually coming down. As you can see, it's actually come up. Net oil equivalent production, it's up 1.2 billion, well, actually 1.17 billion up to 1.22 billion. I think it's just the fact that, gas prices just come down. So I think that's the main issue when it comes to this, right? I think that's the main issue when it comes to this. In fact, U.S. upstream's earnings were lower than a year ago, primarily in lower realizations, partially offset by lower operating expenses due to the absence of a 2022 early contract termination and high sales volume. So there you go. There you have it right there. All right. So with that said, guys, let's come into now the calculator. We got the ticker for CVX, market cap of almost $297 billion, a P of 8.59, a current share price of $158.87. Now, please remember that this company, guys, will follow oil very tightly. And we have seen all the earnings, I guess, when it comes to the upstream coming down, even though the price of oil hasn't really changed much, right? Well, I mean, it has changed much. So here we have the price of crude oil, and well, if we come over here to the 5-day, we can see that it has remained roughly at around like the $70 mark, right? 76. And even though that's low from like the peak, which if we come over here to, let's come over here, 5 year, I guess you could say, yeah, from a peak from 5 years ago, $120 or so. The fact that they're going this low, right, when it comes to all their upstream earnings and all that stuff, even though it's at 70, tells me that, yeah, the guys, this is a major thing, right? The price of oil will dictate this company's profits, period, down the, which it's obvious, right? It's obvious. Nonetheless, though, just keep that in mind. Now, if we take a look at this company's graph in the 1 year, oil has been on a tear. This is up 5.64, though it has come down, but still up 5.64. Year to date, yeah, this thing is down 8.69. 52-week range is $140.46 to $189.68, which was the peak, guys. A peak of $189. That's absolutely insane. So let's come back over here. They do pay the dividend of $6.04. Now, I am not sure. Yes, it is, guys. Yes, it is. This is updated with the current earnings. This is a yield of 3.8%. Look at that payout ratio of 17.44, a 5-year growth rate of 5.9, 35 consecutive years of dividend payment. Ex-dividend date passed as of May 18th, and they just paid out in June, and they just paid out in June 12th. And of course, they do pay their dividends quarterly. Now, full disclosure, I do own this company. In fact, let me show everybody how many shares I got, as well as my average share price. So here we got the company. If I put in over here, we got CVX. We got, guys, that I have 123 shares of this company. Amount invested $12,508. Capital gains and losses, I am up on this thing $7,032. And the reason is because, well, take a look at this. Take a look at that average share price, $101.69. Now, I had a friend, right? I had a friend that when oil went negative in 2022, he was just like, dude, you gotta buy oil. You gotta buy oil. And I said no because I was afraid. I'm like, I've never seen oil go negative, blah, blah, blah. And I should have listened to him because I had the opportunity to buy Chevron. In fact, let me show you guys exactly. I had the ability to buy Chevron, I kid you not, at a low price of $55. Oh my Lord. So if we actually do a little bit of math over here, if we come here to the calculator, again, I have 123 shares, right? So let's say like at peak $189, right? $189 minus 55, right? That gives me the difference of share appreciation times 123 shares, which is what I have, right? That is a gain of, $16,482. So y'all can tell I'm a little bit salty on this. Now, obviously, this 123 shares that I do hold, I didn't buy them all in one swoop, but averaged at around $101. Still, though, if I would have bought this thing at the low of $55, oh my Lord. But it is what it is. Nonetheless, though, this company does pay me a really good dividend. I think Verizon pays me the highest dividend. I think I may be wrong on the fact that I said Chevron pays me the highest dividend. No, it's actually Verizon. But Chevron pays me the second highest dividend at $185.73 per quarter, which is insane. Now, I'm very interested as to what the discounted free cash flow says for this company because, well, with a PE of 8.59, I might actually pull the trigger again on this. Now, based off of the $6.04, which they just announced that they were going to increase it to this much, they pay out $11.3 billion in dividends every single year, a 5-year average free cash flow of $6.81 billion. But look at that last year's free cash flow, though, $26.35 billion. That is an insane jump, right? That's an insane jump. Last year's free cash flow payout ratio. Last year's free cash flow's payout ratio is 29.97, essentially 30%. 5-year average is a bit high, 62.35, but again, I bought this company 3 years ago, right? So you look at this and you're like, 62 isn't really, it's higher than the 60% I like, but it's still within, I guess, that margin of safety for me. So let's jump down into the actual numbers. We got 5 years ago, guys, on the net income, almost $15 billion. To 1 year ago of $35.46 billion, increase of 139%. Now, two big outliers here is, of course, 3 years ago. This one can be ignored because of COVID. Oil, crude oil went negative. Now, the 4 year ago is actually very easily explained by the fact that if we come back over here to the graph, actually, if we come over here to the crude oil graph, take a look at this on the 10-year. Now, 4 years ago was what? 2019, right? So if we come over here, we can see that oil, as of late October 2018, it was $74.34, pretty much in line with what it is right now. However, the beginning of 2019, look at this. Oil went from $74 and it's steady there around like 55 to a peak of what, $63. So we just saw that massive drop when it comes to upstream, when it comes to pretty much everything in Chevron, based on the oil supply, or not the oil supply, sorry, but the oil demand going from what, $120 down to a low of 66 and hovering around the $70 mark for the past year and a half, or half a year to a year and a half, right? So the fact of the matter is that going from 120 down to 70 is bringing it that low. Yeah, I'm looking at this and I'm like, man, going lower, going to like around $55, it's probably going to cause even more damage. So I'm looking at this net income and I'm like, I think this is perfectly explainable. Of course, the 2 year ago and the 1 year ago, we know why this occurred, right? We know why this occurred. Now, this year, by the looks of it, it will come down again, but they just explained their earnings as to why it is occurring. So all in all, I'm actually going to give this, again, it's tough because it follows the oil prices. So I'm gonna have to give this, I would say, like an 80%, a solid B-. Looking now into the free cash flow, 5 years ago of 16.8 billion to 1 year ago of 37.63 billion, increase of 124%, with an average of $18.1 billion. Pretty much everything that I said with the net income is applicable here. And also the fact that we might nothing. We will see this thing come down this year because not only of their acquisitions, but also, as they said, they're going to reinvest back, right? They're reinvesting back into the United States. So that's essentially that, right? I mean, CapEx in the second quarter was up 18% a year ago, primarily due to higher investments, which I'm not mad about that, right? I think they should invest more in the United States. So all in all, I'm going to give this thing, once again, like an 85%. Looking now into the revenue, you got 5 years ago of 151 billion to 1 year ago of 236 billion, increase of 56.2%. Again, all these graphs look very, very similar. So I'm going to have to give this one pretty much the same grade, right? An 80%. Yeah, it's all about what oil does. So yeah, it really is. It is what it is, man. It is what it is. Looking now at the assets minus the liabilities. This one's actually looking interesting because, well, you can see they were coming down from 5 to 3 years ago, perfectly explainable, and then they're coming back up. Most likely, the fact that they're acquiring this, again, they are focusing on higher investments too in the United States. This will probably either remain the same or go slightly higher. In fact, actually, no, I'm so terribly sorry for that. Take a look at this. This is the current year. It's already higher by around $200 million or so. I think that the current acquisition, obviously, they're going to pack on those liabilities, but at the same time, if they're expecting $1 billion in free cash flow, I think that it will be more of an asset. Obviously, companies would look at it more of an asset than anything, so I think this will beat 1 year ago, so it is what it is. Average total assets, it is 246.1 billion. Average liabilities is 98.4 billion. Doing this difference, we get 147.7 billion. I have here an 85. I think I'm going to keep it the same at an 85%. Looking now into the cash flow minus the liabilities, this is looking amazing, man. Now, I do expect this thing to come down again this year because of everything that we just talked about. But aside from 3 years ago, this is heading in the right direction, right? 81.4, 79, 78, 59.8. Average, it is negative 80.8 billion. As of 1 year ago, this is significantly lower, or I guess higher than the average. So I'm actually going to give this a 95%. Now, looking at the shares outstanding, they had instances where they brought it up, but it was only 3 and 2 years ago. Again, understandable, COVID. 5 years ago, they had 1.9 billion shares. To today of 1.867 billion shares, it's a decrease of 1.87%. And from the previous year to the current year, it's a buyback of a little bit more than 2.5%. And the earnings report just said that they are planning to buy. Actually, they are planning nothing. They have bought back, right? If we come back over here, the CEO, I believe it was the CEO, he said, was it the CEO? Was it the CEO? Was it? No, it wasn't. It was right here. It wasn't in the financial highlights. Shareholder distributions were record 7.2 billion, including, okay, the dividend. Repurchase 4.4 billion over 27 million shares and 50 million shares year to date. So I'm looking at this. I'm like, they're buying back shares. And if this thing goes lower, I think they'll buy back even more. They're not stupid. So I'm going to say at around like an 80% again. yeah, I do like the fact that they are buying back shares. This right here is explainable, of course, COVID, uncertainty, oil going to the negatives. And lastly, when it comes into the cash and equivalents, they currently hold $15.67 billion with an average of almost $10 billion. Overall grade, net income 80, free cash flow 85, revenue 80, assets and minus liabilities 85, cash flow minus liabilities 95, just standing up 80%, overall grade of 83. Now, you're looking at this and you're like, you have given other companies a lot lower grade because of the choppiness of the graphs. Right, but the thing with that is, I don't have an explanation for that. With this one, I do have an explanation. So it's all about having the explanation, right? Again, investing is an art, guys. It really just depends as to how you look at things. That's why Charlie Munger and Warren Buffett, they could analyze the exact same company and come up with two completely reasons as to why or why not to invest. So it's an art. And this is why I give all these calculators out for free, as well as the grades, because my grade's going to be different than your grades. You see something you don't like, I see something I like, right? So it really just depends as to what part of the company you look at. So 83% for me. I absolutely love this company, hence the reason why I do hold it. But will I want to keep buying into this company right now? My average share price is $101, so it would take a lot for me to look at this thing and be like, oh, it's a buy now, even though I'm dollar cost averaging up, which is not something that you would want to do. But let's actually take a look at this. Not doing anything, guys, not inputting anything. We can see that, well, not adjusting for debt, this is $143.02. And adjusting for debt, $147.45. Already this is looking good. So let's input some of these numbers, all right? Let's input some of these numbers. Let's start off with the projected share buyback. They have around, what, 2%? So let's say that let's just do the pity one. Let's just do 1, 2, and 3% when it comes into the projected share buyback into the future. Now, when it comes to the revenue, right, this one's going to be a little bit more difficult because it really just depends on what oil does. We got revenue here in Seeking Alpha, 7.38%. I'm going to say worst case scenario, crude oil, actually, I guess worst case scenario is that crude oil stays the same, right? Best case scenario, or at least, well, you know, best case scenario for the company, worst case scenario for us is that crude oil rises and gas prices just goes through the roof. Obviously, that's the worst scenario for us, best scenario for the company. So I'm looking at this and I'm like, okay, let's just say that oil remains the same as it is right now, right? So, or at least this is go up slightly. So with that said, I'm going to say 7%. Let's actually say at around like 6% for the highest assumption. Let's go with 4% for the median, and for the revenue, I'm sorry, for the low assumption, let's go down by 2 again, and let's say 2%. I think that's pretty fair. Take a look at these numbers, guys. 155 to 182. That's interesting. That's very interesting. And adjusting for debt, 159 to 186. Margin of safety of 5, 10, 15, 135 to 177. It's interesting because, well, pretty much on all of these, except for some of the margins of safety, on all of these, we are right there, right? We are right there. But also take a look at this. Adjusting for debt, we got 186. And if we take a look back at this graph, we can see that the high point was 189. And when did that happen? I think that happened just a year ago, right? If I'm not mistaken. Obviously, it's a year ago. It's in the 52-week range. But to be exact, I believe that got close to in November 15th, 2022. So I'm looking at this and I'm like, you know what? If oil keeps going up, I think Chevron will start to go up too. And I don't see any signs of oil coming down, seeing that OPEC is just like, nah, we're limiting oil production. We ain't doing this. We're limiting oil production. So that's going to cause the supply to go down, meaning demand. If demand remains the same, it's going to cause prices to go up. I'm looking at this. I'm like, I actually may begin to start buying shares, guys. I get that my average share price is 101, but man, I'm looking at this. I'm like, I think this will continue to go up. So that's not a definitive thing, but just for me, I think I'm going to start buying back shares. Obviously, that's just my personal decision. Of course, you guys do whatever you want with your money. That's not financial advice. Every investment is the present value of all future cash flow. So with that said, have these calculators for free. They're all available for free. Link is in the description below, as well as the way to grade, guys. Please use them. This is not, as I said, it's not financial advice or even due diligence. So just do with that information as you will. I think I'm going to start buying very soon. probably like when market opens on Monday, right? Depending on where this thing is. But yeah, like tell me what you guys are gonna do with Chevron, because I'm very, very interested in what you guys might do with this company. And of course, please remember that the best way that you guys can help us grow is just by liking, subscribing, commenting, and of course, sharing. Right? It really, really does help, guys. Sorry for not live streaming on Friday. I had important matters to handle. But this week that's coming up, it's gonna be bonkers. All right, so we're going to do every single week this week, I promise. And it's going to be interesting, especially on Thursday, because, yeah, Bud Light is reporting, and that's going to be fun, right? It's going to be really, really fun. But, again, if you guys would like to support us, we appreciate, you know, if you guys were to, like, you know, give us tips and that kind of stuff. But at the end of the day, you know, like, subscribe, comment, and just help us grow. We're 300 subs away, we're at 2,700, so we're 300 subs away from reaching 3,000. Prove me wrong, right? I don't think we're going to do it, but prove me wrong. If we can get to 3,000 subs by September 3rd, then Mike will start doing face cam. So there you go. There's your incentive, or I don't know how you would take that, but so there's your incentive for you guys to subscribe. So thank you all so much. We really, really do appreciate it to all those who have done that. So taking a look now at this company at the current share price, guys, putting in $5,725, this nets you $217.67, guys. This is looking good. This is looking really, really good. And so far, all of this is looking great, right? All of this is looking great. So, yeah. Dividends, I think this company is fairly good when it comes to the affordability on this dividend. All right, guys. So, taking a look at now the options chains. And, of course, because I have 100 shares of this company, I do sell covered calls on this. And I usually sell these for, like, a weekly covered calls for about, like, $20 or so whenever I see like this bid get to like $20, around 20 to $25. So I do tend to sell covered calls on this, and it's actually been very, very profitable. You know, $20 a pop a week, that's pretty good. Now on the put side, yeah, for this week of August 4th, or for the week ending on August 4th, yeah, okay, so for this company, if you want to sell a put, you would definitely have to go a lot further out. I would say about like a month or maybe even 2 months. Nonetheless though, for the week of August 4th, these are the puts and of course the calls. All in all, yeah, I mean, I absolutely love Chevron. My one mistake is I didn't listen to my friend when he told me to buy when oil was at negative. Nonetheless though, I am highly considering buying more into this company, even though my average share price is a lot lower. I just think that oil is going to skyrocket like we have seen this past year and a half. So that's what I'm going to do. Tell me what you guys are going to do. Nonetheless, though, that pretty much does it. Thank you all for watching. You guys can follow us on the new tech sites. Link is in the description below. So with that said, peace out, and we'll see you all next time.